Hey guys, welcome to your channel. Friends, this is an elephant. Elephants are incredibly powerful creatures. They can easily uproot a strong tree from the ground, yet they are often tied up with a thin chain. Even though these strong animals can easily break that chain, they don't even try. But why? This story begins when the elephant is a baby, and it's captured. At that young age, the elephant isn't strong enough to break the chain. In the beginning, it tries really hard to break free, but it just can't. After some time, the baby elephant comes to believe that it will never be able to break the chain. And even when it grows up and becomes strong enough, the elephant remains locked in that chain for the rest of its life. The reason is simple: the elephant has accepted in its heart that it cannot break the chain. Similarly, many people around the world accept that they will never become wealthy by saving and investing. But does that mean they can never become financially successful? Or are they just financially weak for now, with the potential to become strong in the future? It might take time to accumulate your first $1 million, but once you've saved that, your second $1 million will come in just 3 to 5 years without you doing much. After that, your wealth will continue to grow in the same time frame. In other words, if you're in your 20s right now, and someone tells you that they've seen the future and know that you'll own $5 million worth of property by the time you're 50, you might find it hard to believe. After all, you're still struggling to hit your first $1 million by the time you're 40. But in just 10 years after reaching your first $1 million, that $1 million can grow into $4 to $5 million. All thanks to the power of compounding. Today, I'll explain this in detail in this video. Now, many of you might be wondering, how do I accumulate my first $1 million? And that's an incredibly important question, because for most people, the first $1 million is the hardest to earn. Even those who manage to save it often don't see it grow quickly enough. So if you truly want to become rich and achieve financial freedom quickly, be sure to watch this video till the end without skipping. Today, I'm going to share some extremely important secrets and concepts with you, the same ones that Warren Buffett and other successful people around the world have mastered. By leveraging these, they became rich and have stayed rich. That's why I can guarantee that by the end of this video, you'll feel just as confident in your financial journey as Warren Buffett did at a young age, even when he didn't have any money. Back then, Warren Buffett famously said, "I knew I was going to be rich." I don't think I ever doubted it for a minute. He understood the force of compounding very deeply. So let's dive right in. But before we start, if you haven't subscribed to this channel, Finlit Finance, hit that subscribe button now and press the bell icon so you don't miss out on any important videos like this. I've divided this video into 3 parts. First, we'll understand the power of compounding with a simple example. Then, I'll explain how this force applies in real life, especially in the stock market. Finally, we'll go deeper into this concept and explore its components with real-life examples so you can start making smart investment decisions. Let's begin by understanding compounding with a simple example. Imagine you're at a job interview and you've just been selected for a 3-year contract. You're excited about your new job. The company's HR comes to discuss your salary and gives you 2 options. The first option is a salary of $1,000 per month. The second option is starting with 1 cent per month, but it doubles every month. Which option would you choose? Take a moment to think about it. Now let's look at the answer. If you chose the first option, you'd earn a total of $36,000 over 3 years, which isn't bad. But if you chose the second option, you would have earned a total of $68,719,940. Yes, almost $69 million, because your salary doubled every month. The value kept increasing at an exponential rate. While a 100% return every month isn't realistic, this example teaches us a lot. The most important lesson is that a significant part of that $68 million comes in the final months. At first, you don't feel like you're making any progress with just a cent or two, which is why most people give up early. Let me give you a real-life example of compounding. In 1980, an Indian investor named Satish Shah bought 100 shares of Wipro for $10,000. He never sold those shares, and today his shares have grown to over 2.5 million shares. With each stock split and bonus, his original 100 shares multiplied over time. Today, those 100 shares are worth nearly $700 million. That's the magic of compounding in the stock market. Can you guess the growth rate that turned $10,000 into $700 million, just 41% annually? This is similar to the interest rates charged by many credit card companies in the US. That's why compounding works both ways. When you borrow money at high rates, it compounds against you. Last year, Wipro paid a dividend of just $0.01 per share. but Satish Shah earned a dividend of over $2.5 million. And remember, we haven't even included the dividends over the past 40 years, which he likely spent. This is an exceptional example, no doubt. But earning 40% annually over the long term is extremely rare. You don't need to aim for 100% or 200% annual returns to become rich with compounding. Even a steady return of 15 to 16% over 15 to 20 years can make you financially free. But if you drop that return to just 10 to 12%, the difference is enormous. We'll explore that in more detail in a bit. So why is compounding so powerful? Let's understand it with another example. Suppose you and your friend each invest $10,000, earning a 15% annual return. In 1 year, both of you would earn $1,500 in returns. But here's the difference: your friend withdraws his $1,500 profit every year while you reinvest yours. By the second year, instead of earning 15% on $10,000, you're earning 15% on $11,500. And after 10 years, while your friend still earns $1,500 each year, you'll be earning over $5,000 per year. One person is living by the rule of simple interest, and the other by the rule of compound interest. Now, friends, believe it or not, many middle-class people don't understand the power of compounding. In school, we're taught about it in a very complex way. Most people only grasp the concept of simple interest. That's why they make their investment decisions based on simple interest principles throughout their lives. For instance, when people see a small profit in the stock market, say you invest $10,000 and it grows 15%, giving you $1,500, most people sell the stock to enjoy that small gain. They treat that $1,500 as free money, then reinvest the original $10,000 elsewhere. And the next time they make another small profit, they sell again and enjoy the cash. What's happening here is that their stocks are compounding, but they're not allowing their wealth to compound because they're constantly cashing out. This is what we call a psychological bias, which I'll discuss in detail in another video. Now, to truly understand compounding, it's crucial to understand its two main components. The first is the rate of compounding, and the second is time. Let's explore the power of compounding rate with an example that might surprise you. Imagine two friends, Rocky and Sunny, both 25 years old, and both have saved $100,000. Since they've worked hard to save this money, they want to invest it in the safest and best possible place. Sunny splits his $100,000 into two parts. He invests $50,000 in a fixed deposit FD and the remaining $50,000 in gold. On the other hand, Rocky divides his $100,000 too, putting $50,000 into a bank savings account for emergencies and investing the other $50,000 in an equity fund, like an index fund, to get the average stock market return. Let's fast forward 20 years and see what their investments are worth. Sunny's FD, with a 7% return, grew his $50,000 to $180,000. His gold, with a 9% return, grew his remaining $50,000 to $250,000. So Sunny's total investments are now worth $430,000. On the other hand, Rocky's emergency savings account, growing at 4%, doubled his $50,000 to $100,000, but his equity fund, earning a 17% annual return, turned his $50,000 into $980,000. Rocky's total investment is now worth over $1 million. Friends, this is the secret to becoming rich: asset allocation. Financial advisors often complicate this topic to make money off you by promoting various schemes. When you're young, in your 20s or 30s, with plenty of time until retirement, you don't need to invest in debt funds like fixed deposits FDs or unit-linked insurance plans ULIPs, which offer only 8 to 10% returns. As long as you have emergency funds and essential insurance policies, you should avoid these low-return investments, as they only slow down your wealth-building process. If a bank offers you a plan combining insurance, investment, and bonuses that gives you 8 to 10% returns, it's actually pulling your returns down. Keep your investments and insurance separate to maximize your returns. Since we're talking about the rate of compounding, here's a small chart to show how even a 1 to 2% difference in returns can significantly impact your wealth over time. Let's assume you invest $10,000 just once, and it grows at a 10% return over 20 years. If you earn the full 10% without paying any extra fees, like when you invest directly in stocks, your $10,000 will grow to $67,000. But if you invest in a mutual fund with a 2.5% expense ratio, even though the fund earns 10%, your return will only be $40,000. That's a loss of nearly 40% due to fees. And this is just from a one-time $10,000 investment. Imagine the loss over a lifetime of investing 1 to 2% in fees each year, it can cost you a fortune. That's why seasoned investors recommend low-cost index funds with minimal fees. Now, let's talk about the second critical component of compounding time. Suppose Rocky and Sunny both invest $20,000 every month. They both plan to retire before their 40th birthday. The only difference is that Rocky starts investing at age 20, while Sunny starts investing at 25. So Rocky invests for a total of 20 years, while Sunny invests for 15 years. Everything else invested amount and return rate remains the same at 14%. By the time they reach 40, how much do you think each has accumulated? Rocky's total investment is $480,000, while Sunny's is $360,000. But because Rocky started 5 years earlier, his investments grow to about $2.3 million, while Sunny's grow to only $1.1 million. This is the power of compounding over time. Even though both invested significant amounts, that 5-year delay cost Sunny half of what Rocky earned. To catch up to Rocky, Sunny would need to invest for another 5 years, but by then Rocky's wealth will have doubled again. So friends, this is the power of compounding. Unfortunately, many people do the exact opposite and take out loans instead of letting their money compound. In an upcoming video, I'll discuss how borrowing works against you when you oppose the power of compounding by taking out loans. That's why Albert Einstein called compounding the eighth wonder of the world. Those who understand it, earn it. Those who don't, pay it. Now, friends, if you work a job and can't start a business, that's perfectly fine. People often say that the only way to become rich is by starting a business, and to some extent that's true. But we're incredibly fortunate to be living in one of the best times in history. With your savings, you can buy into existing businesses and become an owner of successful companies, allowing you to leverage the power of compounding to grow your wealth. So friends, I hope you learned something valuable from this video. If you did, please hit that like button so I know I'm providing value to you. Share this video with your friends and family so they can benefit from this knowledge as well. And if you haven't subscribed to this channel yet, please hit that subscribe button now. I promise to keep bringing you more insightful and knowledgeable videos like this one. Thank you for giving your valuable time. Goodbye.